Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically after completing the Indian banking system in the subheading, we had started the Reserve Bank of India in the previous lecture. Okay, we had discussed the facts and figures like the establishment. Okay, we had studied the history and the formation of the Reserve Bank of India. Okay, we had studied the early circumstances. Okay, and we had discussed the nationalization of it. Okay, and as well as what we had discussed, basically we had discussed the one thing which is known as the monetary policy, right? So these are the things which we had discussed in the previous lecture. I hope that you have revised them before you have come for this lecture because as I have told you many times, it is for your own benefit. If you are not revising them on the regular basis, things will be pile up for you, and when you go for examination, this will be hard for you to revise all the facts and figures and keep them in your mind. Okay, so please make sure that you should revise the facts and figures we discussed in one lecture before you go for the another lecture. All right, so now let's move ahead. So basically, okay, there is a one thing, like these were the topics we are required to cover in this particular series of the Reserve Bank of India. We had completed the introduction part, then we had done with the monetary authority. Now we are left with the banker to the government, bankers bank, forex custodian, regulator and supervisor, monetary policy, and the forex management. Okay, these are the topics we are left with. Okay, so now we will start with bankers to the government. Okay, banker to the government. So please remember in the 1949, before starting this particular series, let me make a picture for you. That was the year of 1949 when the RBI was nationalized. Got it? And previously it was working as an private body. Got it? So after the nationalization, it becomes the banker to the government. And what does it mean? Let's see. As the banker to the government of India, the Reserve Bank of India plays a pivotal role in managing the government finances. Okay, basically, if you remember, I had told you that the RBI is basically apex institution to maintain the banking and financial institutions, right? Secondly, we had discussed that it is in charge of the monetary policy, right? Third thing we had discussed is that Ministry of Finance is basically in charge of which policy? In charge of fiscal policy. Okay, now we know that the monetary policy and the fiscal policy are interdependent. Why? While the monetary policy deals with the money flow, okay, fiscal policies deal with the expenditure and revenue of the government. All right, but it is also somewhere related with the money flow. If the government is planning to expand the more, ultimately the money flow will be higher. Okay, if the government is planning to spend less, ultimately the money flow will be lower. Okay, so if we go by this picture, basically we could say that there is an interconnectedness. First thing we had see that the RBI is having the relevancy, and you can say interdependence, or you can say interconnectedness with the Ministry of Finance. Secondly, if we talk about the government, then basically government is required borrowings. Okay, why borrowings? Because if we talk about India, all right, so remember in India, government generally spends more, earn less. Okay, it means that we always having a fiscal deficit. Fiscal deficit. Why? Because our expenditure are much higher than our revenue. Got it? Because of some welfare schemes, developmental schemes and all. So basically you can say, suppose if the government is planning to invest the 1000 crores, but our revenue is only about 800 crores. So how much money we required? Basically we required rupees 200 crores more, right? And this will be arranged by the borrowings. Got it? And for borrowings, generally government issued the bonds and securities. Okay, and the person who will buy this bond and securities will pay the amount to the government. In return of it, the government will ensure a particular interest payment to the bond holder or the security holder. All right, and all these things will be done by one agent of the government. And what is that agent? The agent name is Reserve Bank of India. Okay, so Reserve Bank of India will be that agent which issue the bonds and security on behalf of the government, ensure the other liabilities, terms and conditions should be done in a proper manner. Got it? So this is the picture I have portrayed for you. Okay, so that you could understand the things better. Now I hope that you could understand it, what is written down here. All right, so let's move ahead. First is the managing government accounts. Now this is the functions of the RBI as a banker to the government. RBI maintains the central and the state government accounts and processes all their financial transactions. This includes collecting revenue, making payments on behalf of the government, and managing the government funds. Okay, if this is written on here, so basically if we talk about the funds of the government, however, we had already discussed it in the previous lectures, but here also I will make sure that you get a revision of it. So basically, if we talk about the funds of the government, then there are three types of funds. Okay. Consolidated fund. Okay. Thereafter, we have the contingency fund. Then we have the public account undertakings. Got it? These are the three types of funds. Okay. Consolidated fund is basically considered as a current account of the government. Why? Because all the transaction, whether to spend or to earn, it means outflow of the money and inflow of the money. All these things are related with the consolidated fund. Okay, whereas the contingency fund is basically maintained for to meet the unforeseen events. It means that rescue mission, natural calamities, disasters and all. Whereas public account undertaking is basically the funds held by government but belong to the people. Okay, it means that government is only holding these accounts, and when the time will come, the government will hand over it to the real owners. It means the public. Okay, so these are the three type of funds. Apart from this, government having different kind of ministries, different kind of industries and all right, so they also having their accounts. So all of these kind of accounts and funds are basically maintained by the RBI or the Reserve Bank of India. Okay, Reserve Bank of India is not only limited to discharge of services for the central government, but they also discharge their services for the state government. Okay, and remember, all these funds which we had discussed, they are at both at central level as well as state level. Got it? Thereafter, facilitating the transactions, RBI facilitates various financial transactions for the government, such as issuing and encashing checks, transferring funds, and providing overdraft facilities when needed. Okay, like you can say, for example, if you are an individual, this is any bank, suppose called XYZ. Okay, for example, so if you want to open the account in XYZ, then you become entitled for the services by the XYZ. Okay, all of your financial transaction, banking services will be offered and done by the XYZ, right? Similar things happen with the government and RBI. For example, in place of the XYZ, now it's the Reserve Bank of India. Okay, in place of that person, now it's a government. Okay, so whenever the government required any kind of banking services, financial transactions and all, RBI plays that role. Why? Because right now the government having the account in RBI, and RBI will act as a bank to the government, and as we had just see, bankers to the government. Okay, advising the government, RBI provides the financial advice to the government on matters related to the banking, finance and the monetary policy. Got it? Helps the government in formulating policies related to public finance and the economic development. Okay, remember, basically, if we talk about these areas, then there are three types of list: union list, state list and concurrent list. Okay, why I am telling you, it is just for your knowledge. Okay, basically when we talk about the power division in India, so basically in India the power is divided on three phases: the local government, the state government and the central government. Okay, so basically going by this, state government, or sorry, central government having its power in the union list, state government is having the power in the state list, and concurrent list is the matters which having the jurisdiction of both the governments. Okay, so in the union list, basically defense, all right, and you can say banking, okay, communication, and other things are mentioned. Okay, in the state list, basically the policing, okay, public health, state infrastructure, and all mentioned. In concurrent list, the matters like the education, like the forest, okay, and other things are mentioned. Okay, in the union list, only the union government or the central government can make orders. In state lists, respective state. In concurrent list, they both can discuss and make the orders. All right. So here, if you just look at this picture which I have presented for you, what you are seeing? You are seeing that there is a word we call banking. Okay, so banking is in the union list. It means that the functions of the banks, the rules and regulations regarding the banks, banking policies, all of these kind of things will be decided by which government? By the central government. Got it? So central government, before deciding these things, basically requires the advice, and the advice has been provided by the Reserve Bank of India. Okay, here you could also see the monetary policy. As I had told you that the fiscal policy is related with the monetary policy. Why? Because the fiscal policy and the monetary policy is related with the cash flow, and the fiscal policy is related with the government expenditure in revenue. So ultimately it is also related with the cash flow. Okay, so if the proper coordination hasn't been maintained by both the areas, it means that Ministry of Finance as well as the monetary policy. For example, you can say, suppose if the monetary policy states that rupees 20,000 crores should be maintained in the economy. All right, this is the monetary policy to counter the inflation or the deflation cases, okay, and to ensure the smooth flow of the economy. But in the fiscal policy, the government claims that they are going to spend rupees 40 crores in the economy. So what do you think? What will happen? Monetary policy states 20,000 crores. Thereafter, fiscal policy states 40,000 crores. It means that 20,000 crores are in excess. Okay, and what it will impact? Basically, it will damage the monetary policy. Okay, and it will lead to the inflation, or you can say hyperinflation cases, and the economy stability will be countered. Okay, so to prevent this kind of situations, what generally preferred that monetary policy and the fiscal policy must be coordinated with each other. Okay, like you can say the government is planning to spend this one, so the RBI should think of how to balance the amount. Okay, so remember this thing. Thereafter, if we talk about the another point, it is the managing public debt. What do you mean by the public debt? Let's understand. One of the key functions of the RBI as a banker to the government is managing public debt. This involves issuing government securities such as treasury bills and bonds on behalf of the government to borrow money from the market. RBI also manages the redemption of these securities. So basically you can say the term here public debt is basically signifies the borrowings of the government. Okay, as I have told you, suppose if the fiscal policy states that the government is going to spend how much, the expenditure will be the expenditure will be 20,000 crores, but the revenue is only about 18,000 crores. How much left? Rupees 2,000 crores are left. Got it? So what will happen? The government will have to arrange this money, or you could say borrowing. The government has to borrow the amount from the market. Got it? This is what we call an expenditure and the revenue part. Okay, and for this, government will basically issues the treasury bills. Okay, you can say the bonds. Okay, securities and all. Got it? So basically, on behalf of the government, all the things will be done by the Reserve Bank of India. Okay, the Reserve Bank of India will issue the treasury bills, bonds and security, will decide the maturity date and will decide the interest and title on it as per the discussion with the Ministry of Finance. Alright, thereafter the treasury bills, bonds and the securities will be issued to the market by the official platform of the Reserve Bank of India. Okay, Reserve Bank of India will transfer the ownership of the bonds, bills and securities to the person who has paid the amount. Alright, thereafter the collected amount will be sent off to the government. Okay, and you can say this is the beneficiaries, Reserve Bank of India, government. Okay, this will be the flow. Okay, first the beneficiary will pay the amount to the Reserve Bank of India, the Reserve Bank of India will pay the amount to the government. First thing. Thereafter, the government will ensure the continuous interest rate to the RBI and RBI will transfer to the beneficiary. Okay, so that's how the public debt manages. Alright, it means how much is borrowed, how much is borrowed. Second is how to borrow. Okay, all of these kind of things are mentioned on the treasury bills, bonds and securities advices to the government which the RBI provides. Okay, how much is borrowed and how to borrow, all these kind of things. Got it? So that's how the government, or you can say the RBI, manages the public debt. Got it? Also, redemption of the securities, what do you mean by it? So basically you can say, for example, however, I will explain you this thing in detail in the upcoming lecture of Indian stock market and the securities market, but right now I'm just giving an overview. For example, you can say the RBI has issued the bond of rupees 10 crores for 10 years. Okay, it means that the person who will buy that particular bond is required to pay 10 crores to the government, and then the government will pay the amount back to him after 10 years. Meanwhile, in every year, or you can say in the end of each year, he will receive some interest. For example, you can say if rupees 10 crore at 1% was promised for 10 years. Okay, so you can say suppose the bond was about at 2000, then it will be matured by 2010. Okay, after 10 years. Meanwhile, in every year, the person who has paid rupees 10 crores to the government will receive 10 lakhs per annum. Got it? This is the basically you can say thing which is known as the interest. Got it? This is in particular you can say maturity and you can say the terms and conditions. All right, we will discuss them in detail in the lectures of the Indian security market. Till then, just keep this thing and keep this overview in your mind. Got it? Then what will happen after the maturity? It means when we enter in the 2010, it means that 10 years has been completed. So what will happen? The government will pay rupees 10 crores to the person who has provided the 10 crores to the government. All right, and then the ownership of the bond will be transferred back to the Reserve Bank of India, or you can see the government. So that's how the system works. Okay, first the RBI will issue the bond. The person who buy the bond will have to provide the money for certain time period. In such a case, it is for 10 years. All right, meanwhile he is entitled to receive a fixed percentage for each year. All right, here it is 1%. Okay, which means 10 lakh rupees. After the maturity, or you can say after the completion of the 10 years, thereafter the Reserve Bank of India on behalf of the government will provide the 10 crore rupees to the person who had paid it, and then the ownership of the bond will be transferred back to the government from that person. Okay, so this is what we call as a redemption of the securities. Got it? Thereafter, monetization of debt. In certain circumstances, when the government needs to borrow money directly from the RBI, the process is known as the monetization of debt. This is usually done to meet the government's short-term financial needs. So basically you can say what generally happens. Suppose if the government requires 2000 crores. Okay, 2000 crores is the requirement of the government. Got it? This is the Reserve Bank of India. This is the Ministry of Finance. Ministry of Finance will pay the amount to the Reserve Bank of India. All right. Sorry, Ministry of Finance will give the instruction to the Reserve Bank of India. The Reserve Bank of India will then launch it to the securities market. Treasury bills, securities and bonds of worth rupees 2000 crores. First case. Okay, but in order to arrange these 2000 crores, they require the subscribers. It means the persons who will buy that treasury bills, securities and bonds. Got it? This will take some time. All right, but what if the government required the money on the immediate basis? Okay, they having the urgent need. In such a case, instead of launching the treasury bill, securities and bond in the securities market and wait for the subscribers, the RBI will directly pay the amount to the Ministry of Finance. Okay, this is called the short-term finances because government could not hold the amount for a long time. All right, that is what we call as a monetization of debt. When you can say on the short notice, when the government is required the money from the Reserve Bank of India, they could directly reach it. Okay, and in order to provide the money, the Reserve Bank of India will then use the monetization of the debt. Okay, instead of issuing the treasury bills, bonds and security, the RBI will directly pay the amount to the government. Okay, so students, basically in this lecture we had discussed the some facts of the banker to the government. In the next lecture we will continue from here. Till then, just revise the facts and figures we had discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture, and what we say thank you.